If you think your bank account feels tight right now, wait and just dropped in the last economic briefings. From hidden crisis in the New Zealand housing market to a massive corporate bailout and a global trade war bring right on the doorstep. Everything is shifting. Here is exactly what is happening in New Zealand right now, what it means for our pocket. Housing and the retail trap. Let's start with the roof over your head. Just released the latest property data showing New Zealand's average dwelling value crawled up 0.3% to over $912,000 on paper. Property is holding, but out in the streets, retail is completely flattening. Paymark reported incredibly overwhelming transaction data for May, especially in Auckland. Retailers are celebrating any growth at all, even if it's way below inflation. So what are the pros for all that? If you're a homeowner, your equity isn't collapsing. What are the cons? People are broke. They are paying mortgages instead of buying retail goods, pushing shops to the brink. What is the future for us? The retail slump will force aggressive winter sales, but expect more local business closures by spring. Well, the shifts and the credit card war. Meanwhile, the banking sector is in a total frenzy. Cooperative Bank just hiked almost all of its fixed home loan rates and term deposit rates. At the exact same time, the Commission dropped a bombshell. They want to cap commercial credit card fees to save Kiwi business $40 million a year. What is the pro for that? Small business get immediate breathing room from a predatory fees and savers get better return on term deposit. What are the cons? Higher mortgage rate means first home buyers are locked out longer. Plus, banks will likely get your credit card reward points to claw back that $40 million. What is the future with that? Free credit card perks are dying. Expect banks to tighten lending even further to protect their profit margins. The corporate debt squeeze. But it's not just everyday Kiwis bleeding cash. New Zealand's biggest corporations are scrambling. Raymond Healthcare is trying to raise $150 million on a massive 6-year bond issue because they only had $10 million in cash left at their March balance data. To get investors to risk it, they're having to offer massive interest premiums. Meanwhile, Sunlit Milk is barely holding on, relying entirely on $130 million loan rollover from its Chinese shareholder, Bright Foods, just to stay afloat. What are the pros? These companies are fighting to keep jobs alive and projects moving. What are the cons? It proves corporate NZ is drowning high-interest debt. What's the future? If major companies are paying near 6% just to borrow survival cash, the stock market is going to see extreme volatility. Keep your close eyes on your KiwiSaver. The government's power play. Let's talk politics. Energy Minister Simon Brown just executed a massive U-turn. He announced that the financial burden for the planned LNG gas import terminal will sit squarely on these power companies, completely backing down on a controversial consumer levy. Simultaneously, the Labour Party just dropped its official candidate list, officially reviving a heated debate on a capital gains tax. What are the pros? No new sneaky tax levy directly on your power bill this month. What are the cons? Power companies aren't charities. They will just raise regular electricity prices to cover the infrastructure. What's the future of that? Power bills will rise regardless of the politicians' political spin, and tax policy is going to dominate the upcoming election cycle. The global shockwave. Finally, look overseas because the global markets are flash. A massive magnitude 7.8 earthquake just rocked the Philippines. US inflation expectations are making small business miserable. And the Strait of Hormuz is at total standstill with 250 ships waiting to cross due to military tension. Yet somehow China's export manufacturing is surging. The Kiwi dollar is holding at 58.1 US cent. while the NZX50 saw gains from a Vulcan Steel and Auckland Airport, but got dragged down by Spark and A2 Milk. What are the pros for it? Global supply chains are proving resilient and despite geopolitical chores. What are the cons? Imported goods are, like electronics and fuel, are staying expensive because of the weak Kiwi dollar. Future. Inflation isn't going anywhere. It's not going anywhere. If shipping lanes stay chalked, fuel prices will spike at the pump within a week's. What's the outro? We are looking at the completely restructured economy by end of the year. Which of these moves impacts your life the most? The housing stall, the